Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video, if you watch my videos, you probably know what the first thing I'm about to say is. Just like clockwork, bought to close my $35 call for $2, and I sold to open a weekly call and a weekly put. Let's take a look at those transactions. And I actually did all of that yesterday, and today I did an extra thing. I sold to open a 34 and I bought to open a 40, which I will explain in a minute. But first, let me go over my weeklies that I closed out and opened. So here's the call, the $35 call that I closed. I spent $2, so I made 30 minus 2. I made about a $28 profit in another week. And now I sold to open a $34 call, and I sold to open a $30 put, and both of those are for next week. Expires December the 7th, 9 days from now. And so if Twitter stays in between those two prices, $34 and $30, then I will make 29 plus 22, which is 51. I will make about $50 in profit. Maybe 48 or 49 if I buy them back, close them out at $2 or $3, depending what Twitter does. If Twitter goes above $34, then I start rolling up the calls. If Twitter goes below 30, I start rolling down the puts, and I continue to sell more calls. And down here I did an extra thing, and these calls expire the following week, so it's a ladder. I did a video on doing ladders, how you can sell to open a weekly call that expires this week and then sell another one for the following week and another one for the following week. Well, that's what I did. But in order for me to do that, the key is this call that I bought. Okay, now if I did not buy this, then that would mean that I would be selling a $34 call on margin, because I only own one call option, right? This one right here, this is my $30 call, right? And so I can sell to open one call, but if I sold to open two calls, then one of those calls would be uncovered. It would be margin. It would be selling naked calls, which I don't even have authorization. I don't even have that level of option approval. But if I did, I don't like selling uncovered calls. There's a guy named James Cordier. If you get bored, go on YouTube or Google search, look up optionseller.com, and have some fun learning about what happened to that guy a couple weeks ago. Big time hedge fund manager that went belly up because he sold a bunch of uncovered call options on natural gas. So if you get bored, look that up. But anyways, back to my transaction here. So in order for me to sell this $34 call, I have to buy a $40 call, and that is $6 difference, right? 40 minus 34. And if we look at my cash balance, okay, I have $1,100 in my cash, and the total available is $973, and so that gets taken out, and that's basically used to fill in that gap. Okay, now if I did not have that cash in there, if I had put all my money into calls, I would not be able to do what I just did today. I wouldn't have the money to cover that distance. And by the way, that's known as a vertical call. When you buy and sell calls that expire in the same week, that's a vertical call. When you're buying and selling calls that expire in different weeks, that's a diagonal call, or actually it's a calendar call. And when you're doing different strike prices, that's a diagonal call. So this is a vertical call, and the vertical call I did again to build a ladder for myself, because if we take a look at what's going on with Twitter, this is Twitter. I already have it all pulled up for you. This is a 1 month chart, and if we look at the trend here, we have this level up here, we have this level here, and we have this level here, and now we got a new level down there. And then on the low end, we have this level, this level, this level, this level, right? So we got the we got the lower highs and we got the lower lows. And so this is known as a channel, and it is a bearish channel. Now, the call and the put that I sold to open, the weeklies, I sold to open a weekly call at $34, expires next week. And I sold to open a weekly put at $30, which also expires next week. And so the $34 level that I sold is right at around there. And the $30 level I sold is right there. So really my big risk is down here. Okay, the chances or the probability that Twitter will go below 30 is greater than the chances that Twitter will go below 34, because this is a bear trend and the trend is your friend, right? So that's why I decided to go ahead, actually I'm going to leave that up. That's why I decided to go ahead and do this vertical spread to create extra income for myself, and I laddered it out to the following week. And so I did one, and I took in right there $35 minus $3, so $32, about $31 and some change, and that will be for the following week. Okay, and that's just the calls. I have not done anything with the puts, so I still got an open slot for the puts. If I decide to do something with the puts, if Twitter drops, I can roll this down. Like, let's say Twitter goes below $30, then I would sell to close this $30 put, and I would buy to close this $30 put, and I would sell to open another $30 put for this week right here of December the 14th. And so we will see what happens. So my targets are $30 and $34. If Twitter goes above $34, I'll be rolling up those call options. If Twitter goes below $30, I'll be rolling down those. And also, if Twitter goes above $34, I will have to roll up the contract, the vertical spread that I did. Let me pull this up again. This one right here, I'll have to roll this one up as well. But I might also be able to hang on to it. And one final thing about this vertical spread here, it's a $6 spread. So I mean, if Twitter went up to like $1 million a share, I have a $40 call. So that's why doing spreads is safe, and selling calls without a spread is not safe. It's risky. I won't say it's not safe. I'll just say you're taking risk. If you just sell an empty call, a $34 call, and you're not buying another call, then if Twitter did go up to $100, I mean, imagine how much money I would lose. 100 minus 34, 66. I'd be down $6,000 or something, $6,600. But with this $40 call, my maximum loss is 600 minus 43. I could lose $560 if Twitter goes to $100 a share in the next 2 weeks. Let's hope it doesn't do that, right? Of course, I wouldn't be doing stuff like that if I thought Twitter was going to do that. You gotta have at least a little bit of sanity in your thinking. You gotta think, okay, chances are Twitter is not going to go to $100 a share in that short of a time, right? And that's the reason I like to sell short-term weekly calls and puts, because in 9 days or in 2 weeks, you know, stock's only going to move so much. Stocks generally don't go up $100 a share in 2 weeks unless I'm really missing something. You know, I've never heard of that and never will hear of that. So that's what I got going on here. So again, quick recap. I bought to close my weekly $35 call for $2, and now I sold to open a call and a put to continue to make income on my leap call and my leap put. This is my leap call. I spent $770 for that. This is my leap put right here, and I spent $767 for that. Total investment of about $1,500, but the call is $30 and the put is $32 strike, so that's a $200 gap. So really it's only a $1,300 investment. And then so the call expires in January of 2020. The put expires in January of 2021, and these weekly calls and puts expire week after week, and I continue to make weekly income. And so to pay for, all I have to do is make $1,300 in weekly income, and then once I make that $1,300 I can do whatever I want, because that will mean that the money that I spent on the call, the money that I spent on the put is paid for, and I will be in the money. I will be in the land of profit, and maybe it will be time to buy another call or to buy another put, and then I'll have 2 calls or 3 calls or 2 or 3 puts or whatever, depending upon how quickly I make this money. So for now, that's what I got going. Right here I have sold to open a weekly call, sold to open a weekly put, and my vertical spread, which is laddered out the following week. The call and the put that I sold to open expire next week in 9 days, December the 7th. Today is November the 29th, and the vertical spread that I did, the $34 call and the $40 call, those expire the 14th, so that's a ladder. I am laddering my profits, and that's pretty much it. That's what I got going. And one final note here, the reason that I'm buying to open this $40 call, it's not because I think Twitter is going to go above $40. It's so that I can sell to open the $34 call. I might have mentioned this before, but I think it's important that if you want to ladder yourself, you have to have some cash balance in your cash. Otherwise you wouldn't be able to do it. If I didn't have that $1,000 in my cash balance, I wouldn't be able to do this vertical call. So that's what I got going right now, and continuing to make that weekly income, selling calls and puts, selling to open those weekly calls and puts. Thank you for watching this video, and if you got any comments, if you got any wonderful ideas, leave it in the comment section and we will see what happens. So thank you, have a good day, and I will see you in the next video.